In this video, I give you the top 5 Dividend Aristocrats to invest in before 2023. Dividend Aristocrats are the thoroughbreds of income investing. When a company has increased its annual dividend payments for at least 25 years in a row, proving unquestionable long-term stability, it is referred to be a Dividend Aristocrat. Stocks with rising dividends that are paid out at a steady rate are sought after by dividend investors. Many people rely on Dividend Aristocrats to deliver consistent yields. However, not every Dividend Aristocrat is made equal. Even those that consistently increase their payouts may see flat or even declining values. These stocks not only rank among the 500 largest public corporations in the United States and are dividend champions, but they also exhibit a consistent track record of earnings growth and indicate the potential for future gain. Number 1. Nucor. Nucor is a leading producer of steel and steel products. It has averaged 35.2% annual earnings per share growth over the past 10 years, and analysts anticipate 40.4% annual growth over the next 5 years, making it the best S&P 500 Dividend Aristocrat. For greater dividends, earnings must continue to expand steadily. Maintaining dividend increases when a company's earnings are falling is difficult and unwise. The price-to-earnings ratio for NUE stock is at 4.3, which is the lowest level in 15 years. This firm's price is underperforming its profits growth. The stock price has fallen 27% from its most recent high during the market downturn of 2022. A strong entry point for long-term investors may be provided by the reduced price, which also results in a higher dividend yield and a lower PE ratio. The 1.5% dividend yield for Nucor has increased an average of 5.8% per year over the past 5 years. Number 2. Cintas. Businesses can get uniform services from Cintas Corp. In addition to facility products including mats, mops, towels, and supplies for the bathrooms. With annual earnings growth of 17.6% over the previous 10 years and annual EPS growth of 11.3% anticipated over the following 5 years, the company has demonstrated consistent long-term performance. The P/E ratio for CTAS has fluctuated during the past 10 years between 20 and 40, with a reading of 36 right now. It is higher than that range. It has fared better than other stocks during the 2022 market storm, currently trading at just 7% below its 2021 peak. Although the 1% dividend yield isn't very high, the payout's dollar amount has grown over time. One of the strongest average growth rates of all the S&P 500 Dividend Aristocrats over the past 5 years has been the dividend amount, which has increased by 20.6% annually on average. Number 3. Brown & Brown. As an insurance agency and broker, Brown & Brown connects customers with insurance providers. It often doesn't take on any underwriting risk and earns money from referral fees. Over the past 10 years, the company's earnings have grown by an average of 13.5% annually. Analysts anticipate future EPS growth of 13.2% annually. A ratio between 20 and 25 is uncommon, especially over the past several years, and Bro's current P/E ratio is 26.6. The current price points to the stock's fair worth. The stock is currently 20% below its most recent all-time high, matching the S&P 500's same decline. A 0.8% dividend yield is provided by Brown. Over the past 5 years, the dividend amount has climbed by an average of 8.9% annually. Number 4. Automatic data processing. Businesses can get services from automatic data processing for payroll, human resources, insurance, and retirement. The company has consistently grown its earnings, averaging 9.5% annually, and analysts predict EPS growth of 14.6% annually over the next 5 years. Since 2014, IDP has performed well with a P/E ratio of 30, while decreases below 25 have been uncommon. The stock is currently trading at 33.7, which is its fair value. The stock is currently trading 7% below its peak. Over the past 5 years, ADP has boosted its dividend payment by an average of 12.8% annually. The stock has a 1.7% yield. Number 5. Target. Target runs both physical stores and a well-known online store. Apart from its 50-year history of dividend increases, experts believe that Target's annual earnings will expand at a rate of 19.6% per year over the next 5 years. This is a significant improvement over the 7% average EPS increase it had over the previous 10 years. The stock price and P/E ratio have fallen as a result of the 2022 stock market sell-off at 18.6. The P/E ratio at present is very similar to the average over the previous 10 years. Currently, the stock is 39% below its all-time high. Target yields 2.6%, and over the past 5 years, the company has boosted dividend payments by an average of 11.7%.